Thank you again for having me on, and welcome everybody. Good morning. It's great to be with you. This morning I did want to speak to you about trading options. I've been trading options for many years, but a long time ago when I just traded stock, I had no idea what options were all about. And like I'm sure many of you hear every day in the media, all I heard about was how risky options were and how you really should stay away from them. I think it's the exact opposite. Once I did learn how to trade options, it completely changed things for me. And today I almost exclusively only trade options. They are fantastic, and they are much safer than what you may hear in the media if you know how to trade them. So that's what we're going to do today. We're going to take a look at options and show you exactly what's possible with this. I am Vince Vora. I am the head trader here at TradingWins. I have been trading for a little over 30 years, and it's been quite a ride, but a great experience. So in today's presentation, I am going to start with some of the options basics. We're going to go over what a call is, what a put is, just break it down, look at the potential profits, potential risks involved with trading options, and then we're going to talk about who actually makes money in the options market. Is it the buyers? Is it the sellers? Who actually makes money? And I'll break down exactly why this is. And then I'm going to share with you a couple of different option strategies. Two quick ones for you, very basic but very effective. And I think this will open your eyes to exactly, what is possible with options. Even with just these two basic strategies, you'll see that there's a world of potential here. And then, of course, if we have enough time, we will answer as many of your questions as we can. Please do remember that trading can be risky, so please don't trade with real money until you are completely comfortable with the system that you are using. So let's start with the basics, and let's start with call options. So I'll give you the definition of a call option, and then I'll break it down for you. So first of all, a call option gives you the right, but not the obligation, and this is key. It gives you the right to buy a specific amount of stock at a fixed price, known as the strike price, anytime before the expiration date. Okay, and for the option seller, that's where the obligation comes in. So here's what I want to break down for you. There's a difference between being a buyer and being a seller. When you are an option buyer, whether you're buying calls or puts, you are the one that are in control. In other words, you get to decide if and when you ever do exercise that option. And that's really a key part of this. When you're the seller, when you sell an option, it's the party on the other side of that contract that gets to decide when and if they exercise that contract. So you're always at the mercy of that other party and never know exactly when you may be exercised. Okay, now we'll go through what that means as we go through the presentation, but just remember one thing: as an option buyer, you have that control. Okay, so if you're buying calls, what's the profit potential? Well, it's actually unlimited, because that underlying stock that call option might be based on can continue to rise to infinity, right? There's no cap on how much it can go up. But the reverse, your potential loss is always limited to what you pay for that option. So again, whether we're buying calls or we're buying puts, okay, your risk is always limited to what you pay for it. So not only do you get to decide when and if you exercise that option and are fully in control of that, but you can never ever lose anything more than what you pay for that contract. That's the real benefit of being a buyer. Okay. Now, if you're selling that call, your profit potential is limited to the premium that you receive for selling that call. Okay, so if you receive $1 per share for selling that call, that's the maximum profit you could ever make on that trade. However, your potential loss is unlimited, again, because that underlying stock can continue to rise. Okay, so there's a big difference here between the buyers and the sellers, but it's also a matter of probabilities, and I'll get into that as we go through the presentation. Now, a put contract, it's the same thing, gives you the right, but not the obligation. That's if you're a buyer. But this time, the put contract gives you that right to sell a specific amount of stock at a fixed price known as the strike price anytime before a specific expiration date. Okay, the put option seller is obligated to buy that stock from you at a specified price if they are exercised. Okay, so now here when we look at the profit potential, it's still substantial because as that stock makes its way towards zero, your put option will increase in value. So it really depends on what price level that stock is at to begin with. If it's a $50 stock, well, it has $50 of room to drop. That's as much profit as you can ever achieve. If it's a $10 stock, then it only has $10 of room to get to zero, etc. Your potential loss, again, if you are an option buyer, call or put, your potential loss is always limited to what you paid for that put. You can never lose any more than that. Now, if you're selling puts, again, your profit is limited to what you receive for the sale of that put, while your potential loss, again, increases as that stock makes its way towards zero. Okay. Now, a few terms that you need to be aware of. What is options premium? Well, that's what you pay for that contract. And this is how we calculate it. So every option contract is the equivalent to 100 shares of underlying stock. Now, it applies the same to futures, etc. But one contract is the equivalent of 100 shares. So if you're trying to calculate what you would have to pay for that contract, if you're buying one call option and the call option is at $1.50, is trading at $1.50, you would multiply 1 times 100 times the $1.50. So your total cost would be $150. Again, if you're the buyer, that is as much as you can lose. No more than that, ever. Can you lose more than that? Okay. What types of options are out there for you to buy? There's these days there seems like there's options on just about anything. First of all, thousands and thousands of them available on stocks. Okay. On the US markets. We have monthly expiries, weekly expiries. They've really come a long way since I started trading these. You can buy options on the index charts, like the S&P 500, for example, the Dow, the Qs, the NASDAQ 100. You can buy them on crude oil, on gold, on wheat, on coffee, on cocoa, you name it. There are options on just about anything you want to buy these days. Now, let's talk about some key terms that you must be aware of. What you're going to hear when we talk about options is you're going to hear about in the money, at the money, out of the money. The in the money amount or in the money phrase refers to an option that has a strike price that is below the current market price of the underlying stock. Okay, so if your call option strike price was 15, but the stock was trading at 25, that means you're in the money. You're $10 in the money. You're $10 below the current market price. For a put option, because put options give you the right to sell, it's the other way around. Your put option strike would have to be above the current market price for you to consider that option in the money. So if your put option strike price was 35 and the stock was trading at 25, you'd also be $10 in the money. The out of the money is the opposite, meaning your call option strike is higher than the market price. And in a few minutes, I'm going to bring up an option chain, and this will all come together for you. I'll show you some examples and sort of wrap this all together. It'll be easier to understand on the option chain, but just bear with me for a moment. So if your call option strike is higher than the current market price of the underlying, that's an out of the money amount. And for a put, your put strike would have to be lower than the current market price to be considered out of the money. For the at the money amount, that is the strike price that is the closest to the current market price. Okay, so if the stock was trading at 25 and there was a $25 strike price, whether it's a call or a put, that would be considered at the money. Now, there's also intrinsic value and extrinsic value. The intrinsic value is the in the money portion, while the extrinsic value is the out of the money portion. So let's go back to our example. If we had a call contract with a strike price of $15 and the underlying stock price was trading at 25, we'd be $10 in the money. Okay, that's $10 of real value. In other words, if you exercised your call and you purchased that stock at $15, you can turn around and sell it on the market at 25. That's why we consider that $10 of real value, or in this case, intrinsic value, okay, in the money amount. If it's trading above the current market price, that's what we call extrinsic value or time value in this case. So think of it this way. This is the strike price, the $15 that we referred to in the previous example. That's the strike price. That's the price that if you exercise your option, you can actually purchase the shares at. But that call contract may be trading at $17. In other words, if it has an expiration, say 2 months out, you'll have $10 of real value and $2 of time value built in there, okay? So the time value and the extrinsic value is the difference between the option's market price and its intrinsic value, okay? Let me go through that one more time. So you have a call option that has a strike price of 15, but it may currently be trading, sorry, I may have used the wrong price earlier. It may be trading at $12, okay? Reason being is $10 of real value. So from 15, the strike price at 15 and the market price at 25, that's a difference of 10. That's real value. And then you add $2 of time value because we have time to expiration, okay? So the difference between the options market price, which might be 12 at that point, minus the intrinsic amount of 10 gives you $2 of time value. So the longer you have to expiration, the more or the bigger the time value component might be. If we have 6 months to expiration, there may be $5 of time value built in there. Again, I'll show you on the option table. Now, there's also what we call implied volatility. This is the estimated volatility of the actual stock, not the option contract, but the actual underlying stock price, okay? So in general, when the stock price starts to decrease, when it starts to drop, that's usually when we get a spike in implied volatility. That's when volatility increases. When the stock price goes higher, volatility settles down. The reason for this is that panic that sets in when markets start to sell off. You know, when stocks are going higher, no one's panicking, no one's worried, everyone's feeling great about the market. But when things start to sell off, that's when people feel the risk, right? That's when the panic sets in, and that's when that implied volatility component spikes. Now, the reason why I'm talking about implied volatility is because it's one of the measures that you will use to decide on whether or not an option contract is fairly valued, undervalued, or overvalued. And again, you know, I'll show you on the option chain in just a moment. So a few facts before we get to the charts. Options really are only risky if you don't know how to trade them. When you really learn how to trade these, you'll realize just how much safer they are to trade than just trading stock. Okay. Now, another fact is that over 80% of all contracts expire worthless. In other words, very few options are actually exercised. Contracts are regularly traded from one trader to another. You know, they change hands on a regular basis, but rarely are they actually exercised. So over 80% of them expire worthless every month. Now, here's where the challenge comes in for most traders. Most people only buy options, but they do so without taking fair value or implied volatility into consideration. So what tends to happen is they tend to buy overvalued options. Okay, so even though the underlying stock moves in their favor or moves in the direction that they were initially thinking it would, they still end up losing money on the option. And that's only because they've overpaid for that contract to begin with. They overvalued it at the beginning and paid more than they should have. And that's why that implied volatility component is very, very important to understand and use. Now, let me try to put this into perspective for you. So when you're buying an option here, and you think of the underlying stock, only 5 scenarios can happen, ever. Only 5. That underlying stock can move in your favor big time, okay? It can make a huge move in your favor. It can move in your favor slightly, or it can just consolidate sideways. It can sit flat and not really move much, or it can go against you slightly, or it can go against you big time. Those are the only 5 possible scenarios for an underlying stock ever, okay? But here's the difference between being a buyer of an option and being a seller of an option. So if you buy an option and that stock goes in your favor big time, of course you're going to make money, okay? If it goes in your favor slightly, you may make money. In other words, you're only going to make money if you understood the fair value and implied volatility components and paid a reasonable price for that option contract to begin with. Because if you overpaid for it, like most people do, you will also lose money, even if it goes slightly in your favor. Okay? Now, if the stock goes flat or it doesn't move at all, you're going to lose money. And the reason for that is for the time value component. As your option contract gets closer and closer to the expiration date, the time value portion of that option contract will diminish, as it'll slowly go down to 0 as you get closer to expiration. So even if the underlying stock doesn't move, you will lose money on that option contract. If it goes against you slightly, of course you'll lose money. And if it goes against you big time, you'll lose even more. Okay. So when you're a buyer of options, you have at best a 2 out of 5 chance of making money here. And in most cases, 1 out of 5. Okay. So remember, 80% of option contracts expire worthless, right? So if you're a buyer, you really have a 20% chance here. That's if you don't understand the implied volatility or fair value component. When you do, it makes a big difference, okay? But as a buyer, again, at best 2 out of 5. Now, as a seller of options, the same 5 scenarios can happen, okay? Nothing else is possible. But as a seller, if the stock moves in your favor big time, of course you'll make money. If it moves in your favor slightly, you'll also make money. Why? Because as a seller of options, you collected that premium, right? You didn't pay for it, you collected it. So if someone overpaid for that option, right, it's now in your benefit, okay? If the stock goes flat, you're still going to make money. Why? Because now the time value erosion is in your favor. You sold that option. Say you sold it at $1.50. So you collected that $1.50 per share, right? Yeah, that's your maximum profit potential. But as time erodes or as the stock goes flat, the option contract diminishes. So it's just like shorting the stock. If you short it at $1.50 and buy it back at $1, you've made 50 cents, right? So as it drops, it's going in your favor. If the stock goes against you slightly, you're still going to make money. Why? Because again, you have a buffer with the time value component. And as that time value component erodes, you're still going to make money. The only way you lose money when you're selling an option is if the underlying stock goes against you big time. So now as a seller of options, you have a 4 out of 5 chance of making money, right? Again, it makes sense when you think of the fact that over 80% of option contracts expire worthless. So if you were to sell a contract, you have an 80% chance that it's going to expire worthless, and you're just going to get to keep that premium. Now, at first glance, this may seem like a no-brainer that you should only ever sell options and never be a buyer. But here's the risk to reward part of this. First of all, if you're a seller of options, remember your profit potential is limited to what you collect for that the sale of that contract. Okay, you can never make any more than that. So your profit potential is limited. So you have a high probability of making a profit, but when you do profit, it's generally small. As a buyer of options, you have a lower probability of turning a profit, but when you do make a profit, you can make much more. Okay, and that's why understanding that fair value and implied volatility components make all the difference. Okay, now when it comes to time decay, have a look at this chart and look at this curved line here that I'm running my mouse over. Okay, as a buyer of options, you want as much time to expiration as you can buy. Okay, the more time, the better, because the time value component or that extrinsic value erodes much more slowly until we get to within the last 30 days to expiration. So if you look at here from 120 days to expiration to 90, okay, this month, there was a very, very gradual erosion of time value. From 90 to 60 days, there was slightly more. From 60 to 30 more. But in the final 30 days, look at how quickly it erodes, right? So if you're a buyer of options, you want to go out at least 90 days, okay? 90 to 120 days. That's what you want to, that's the type of expiration date you want. If you're a seller of options, you want to sell options with no more than 30, maximum 40 days to expiration, because you want that option to expire as quickly as possible and collect that premium. Because imagine if you sell it here 30 days and the stock goes flat. Every day that goes by, you're making money on that time value erosion. Okay, so as a buyer, you want time. As a seller, you want the least amount of time possible to expiration. Okay, so now let's talk about a couple of strategies and how we can actually use this information and make money trading options. So first of all, there's dozens of option strategies out there. Today we're going to focus on long calls or puts and talk about protective puts as well, but not much of anything else here. Maybe some covered calls, but there are dozens of strategies. The more complex ones are butterflies, iron condors, etc. The key is to understand when or how to use each one. Okay, each one is used in a different way at a particular time, at a specific time in the markets. The good news is you don't need to trade them all. You really only need to trade the ones that make you money. And what I mean by that is just learn one of these at a time. Even understanding just long calls or long puts will allow you to make money trading options. Really learn these well, understand them extremely well before moving on to the next strategy. You don't need to learn everything about options before you start trading them and learn every single strategy. Just start with the basics and take your time. So the first strategy, we're going to talk about how you can actually trade Starbucks for less than a cup of coffee. Now, I know Starbucks isn't the cheapest coffee out there, but it's still pretty inexpensive when you're talking about trading. So let's look at a chart of Starbucks here. Now, when I look at the daily chart, I'm really not seeing any reason to buy here. But as we, look at the higher time frames, maybe, the weekly's been consolidating for a while. The monthly looks even better. So let's just assume today that we think that Starbucks is going to go higher. Okay, so we want to look at some call options. Okay, we want to take advantage of this. Now, think of it this way: if we wanted to buy 100 shares of Starbucks, it's trading at 56.75 right now. Okay, let's round it up to 57 for easy math. 100 shares times 57. We have to spend $5,700 to buy 100 shares. Now, if we do that, the full $5,700 is at risk in the market. Now, we can say, well, this isn't going to go to zero tomorrow morning, right? But you never know. Back in here on this earnings date, the stock gap from 60 down to 57, right? $3 overnight. It happened back here. Anything can happen. Look at what happened to Symantec this week, down 20% overnight on a news story. It happens. The point is, we'd have to spend $5,700 to purchase 100 shares of Starbucks. Let's go to the option chain now. And first, let me explain that what you're seeing on the left here are the different expiration months, okay, and weeks. And these numbers in the brackets are telling you how many days are left to expiration for that particular month or week. So if you look at this week, there's 3 days left to expiration for these options. And if I open that, you'll see that these are all the strike prices, 40, 45, 47, and on. Many, dozens and dozens to choose from, okay? But you can see that you can buy options with a three days to expiration all the way up to almost 2 years, right? These are what we call leaps. Anything a year or more is what we would call leap contracts. And you can see the January 2020, 612 days to expiration. So there's a lot we can do here. On the right are the implied volatility figures, which I'll come back to in a few minutes. So remember what I said, if we're a buyer of options, you want to go about 90 to 120 days out, right? If you're a seller of options, you want to go 30 days or less. Since we're looking to buy a call, I'm going to go out to September here. That gives us 129 days to expiration. Now, on the left side of my screen here, these are the call options. And on the right, these are all the put option contracts. In the middle, here's the strike price column that we see. So remember, if we bought 100 shares of Starbucks at 57, that would cost us $5,700. For us to buy 100 shares or the equivalent of 100 shares with a call option contract, that would mean one contract. We can go out and buy the $60 strike price here for about $1.30, right? Now remember, that's 1 times 100 times $1.30. That means that would cost us $130 to buy the equivalent of 100 shares of Starbucks. So we have a choice. We could pay $5,700 or we could pay $130. And remember, as a buyer, the most we can lose is what we paid for that contract. Okay, Nick, yes, this is the Thinkorswim platform. So that's a huge difference. So think of it. First of all, if you have a smaller account, you may not have $5,700 to put into one stock, right? Secondly, spending 130 and risking 130 is much, allows you to sleep much easier at night than having 5,700 in one stock. Now, if you buy the 100 shares of Starbucks, and it goes up $1, you're going to make $100, right? Profit. If it were to go up $1 with these, buying the call option, you wouldn't make the full $100. It depends on which contract you buy. So without going into a deep explanation of delta is the measure of how much you're going to make or lose with a $1 movement in the underlying stock. So if we look at the 60 strike here where we are, the delta is 32. That means for every dollar move in the stock, we'll make 32 cents or lose 32 cents, depending on which way the stock moves. That's only for that next dollar. These figures change. So if Starbucks were to go higher by $1, we'd make $32 profit. If it goes up another $1, the delta would probably change and go up to 35 or 38. So we'd make like $38 on the next dollar, etc. And it would continue to go higher. So now you may think, well, I'm making $100 here. If I buy the call, I'm only making 32. But you're making $32 on a $130 investment compared to $100 on a $5,700 investment. Big difference, right? So we can just buy the call option, and as long as Starbucks moves higher or ends above 60 on expiration date, which is September, we will make money, right? Now, there's another way we can do it. We can buy the stock at 57 and buy the put for protection, okay? So if we buy the stock and it's currently at 56.75, let's say, and we're gonna pay about $4.25 or so for the put option, that means that our total cost is roughly $61, more or less, right? So $61, but we have a strike price of 60. The put contract gives you the right, not the obligation, but the right to sell it at this strike price. So even though we've invested $6,100 here, stock plus the put contract, we have an out at 60. So our total risk is roughly $1, right? Roughly $1. So now, why would we want to do this rather than just buying the call on its own? Well, if we had the money to put in here, if we had the money to spend $6,100, yes, our risk would only be about $100, no question. So it's still just as safe, if not safer. But the reason why we would want to do this is because it gives us more flexibility. As the stock price moves, we can rejig our position. And as the stock went up, we can roll up the put and lock in more profit as we went along. We could also sell a call against the stock that we have, okay? So as the stock price moves up, the option premium on the call side will increase. So if Starbucks went from 57, say, to 65, these calls would be much more expensive. And at that point, we could sell a call against our stock and collect that premium, lowering our cost basis and making even more money. So the beautiful thing about options is that they really give you a lot of options. Options give you options, what we like to say. You have a lot of flexibility. There's a lot you can do with them. But at first, as I mentioned, what you should do is just learn the basics and stick with it. Don't go beyond that. So stick to buying a call or a straight put if you thought Starbucks was going lower, and try to understand that fair value component. And that takes me to the next strategy that I want to share with you. And you can use this around earnings season. How many of you trade earnings? Now, most people that I've seen trade around earnings, they'll try to buy a call option or a put option, the day before earnings, for example, hoping for a big gap one way or the other in their favor, and then selling that contract for a big gain. But what ends up happening is they usually lose big. and Nick is saying earnings are dangerous. Here's why, okay? And James, here's the right way to do this, okay? Let's look at an example. So let's look at Macy's. Macy's has earnings coming up, okay, this week. If we look at the chart, earnings are due, well, tomorrow on the 16th, okay? So perfect example. So if we go back to the option chain, on the right side here, these percentages, this is what we call the implied volatility. Now, most stocks, when you look down this column, they will, on average, be in a certain range. So for the most part, all these expirations are in the, the 50% range, high 40s, low 50s, that sort of thing. If you look at the one that expires this Friday, it's at 105%, okay? So as you get closer and closer to that earnings event or any major announcement that is due out, the premium will spike, okay? Because where there's demand, obviously price goes higher. So it will spike. So if you were to buy this option today, the May option, in anticipation of grabbing a big profit when the stock gaps tomorrow, the reason why you'll lose is because as soon as the earnings announcement is released tomorrow, this implied volatility figure will drop back in line with the average. So it'll go from 105 back to the 50% range. So you'll immediately lose half the value of your option instantly, regardless of what the underlying stock does, okay? And there's much more dramatic examples. If we look at, for example, NVIDIA, okay? Let's go back to NVIDIA. NVIDIA released earnings, when was it here? The 26th, I believe? No, and the 10th. Okay, so let's go back. Let's go back here. Let's close these. And TOS has a feature where we can look back here. So if we go back to the 10th, okay, have a look at the implied volatility on the 10th because they released earnings after market close, okay? That expiration for May was up to 121.70%, where the average here is high 30s, low 40s, right? So now, if you had bought that contract the day before, you're way overpaying. You're paying like 3 times the average amount that you should be paying, okay? Now, if I go over to May 11th here, one day later, have a look at what happens to the implied volatility figures. That same one in May that was 121% is now below 7%, okay? You've lost just about everything. The full value of that contract has been lost, okay, because of that implied volatility crash, and everything else is back in the 30s. So even though it gapped in your favor big time, you lost because of the implied volatility figure. It's because you way overpaid to begin with, and now it's just falling back in line, okay? So the only way you're ever going to make money on a move like that is if the gap is so big in your favor that it overcomes the volatility crush. So the real key to trading earnings is to look for a move like this that happened back in here 2 to 3 weeks before the earnings date. We can always find out what that earnings date is ahead of time. And 2 to 3 weeks before, start looking for a proper setup with whatever strategy you use. Start looking for a proper setup. And then you want to purchase that option contract 2 to 3 weeks before as we head into that earnings date. The reason being is you're going to get that volatility spike. So even if you bought that call option contract and the stock traded sideways for the next 2 weeks, your implied volatility is going from the mid 30s to 100 or 120. You're gaining big time on that option with the stock doing nothing. But if the stock appreciates like it did over here before this earnings date, now you have an even better scenario. Not only is that option contract appreciating because of the stock price going up, but also because of the implied volatility spike. And even if it were to go against you slightly, you make up a good portion, if not all of it, because of the implied volatility spike. So that's the right way to do it, okay? So this is really how you should be trading earnings and options. Now, I only have 5 minutes left, so let me tell you about a class that we put together that really expands on this. If you go to tradingwins.com/May for the month of May, tradingwins.com/May, we should have the link in the chat. What we're going to send you here is a 2.5-hour on-demand recording of a class that we put together titled Crush the Market with Options. So in this class, I'm going to teach you everything I did here today, only in much more detail, along with a lot of other option strategies that I had listed on that previous slide. So we're going to talk about selling options and how to create a steady weekly income using credit spreads. I'm also going to show you one of the more sophisticated strategies called a butterfly strategy. And this one is fantastic because the risk reward is so much in your favor. Usually you're risking 1 to make 9 or 10 times your money. So it's really common for you to be able to buy an option contract or set this trade up for about $90 and have the potential to pull out 1,000. Okay, and if you're buying multiple contracts, you can just scale that as much as you want. Also, there are many times during the year when the market kind of goes flat or sideways. I'm going to share with you a couple of different delta neutral strategies so you can also make money during those flat times. And more importantly, I'm going to share with you some repair strategies. No matter what type of trade you're in, if it doesn't go your way, I'll show you how you can use options to repair that trade and either minimize the loss or eliminate the loss completely. Also, as a bonus, we're going to throw in a 30-day membership to our TradingWins Pro membership. What this includes is nightly videos from myself every Sunday to Thursday. So 5 times a week after market close, I'll send you a video recapping what happened in the markets that day, where I think things are going. And that's also the platform where I share my trade ideas, what I'm doing in the market with you. Also, as a member, we'll get together twice a week. We have live market chats every Monday evening and every Thursday morning with our members. You get to come into our live room, ask me any trading related question you like. It does not have to be on options. It does not have to be on a specific strategy. It can be on anything you're struggling with your trading. I'm there to help you with. And also, as a pro member, once a month, we do what we call a course of the month for our pro members at no additional cost. So you're going to get in this package a copy of the 2.5-hour course called Crush the Market with Options. You will get at least 8 live market chats with us that will be recorded. So if you're working, you can't attend live. They are recorded. They'll be put in your own personal video library for you to watch. And you'll get that course of the month when we do that later in this month as well. So you'll get all of that for just $7. Again, the link is tradingwins.com/May, and you get all of that for just $7. Obviously, it's not a money maker for us. What we'd like to do is for you to get an idea of what we do here at TradingWins. We're quite proud of it, and we think you'll enjoy it and learn a lot. So really hope you can take advantage of this. I see a couple of you asking for an email address. You can reach me at info@tradingwins.com, info@tradingwins.com. Feel free to email us. And I see a couple of you asking for one-on-one coaching. We do have that available. Again, just email me and we'll send you some details on that. The market chats happen Monday evenings at 8 p.m. Eastern, 5 p.m. Pacific, and Thursday morning, 10 a.m. Eastern, 7 a.m. Pacific. Again, they are recorded, so if you can't attend live, you'll see the recording. And I think I'm out of time. So I'd like to keep our host on schedule. Thank you very much, everyone. I hope you enjoyed it. Again, the link is tradingwins.com/May, and you can reach me at info@tradingwins.com. With that, I'll pass it back to our host. Thank you very much.